some technical talk. Ray and Bibby, Richmond Asset Management CEO, is with us on the show.
Hi folks, welcome to the Bloomberg Edge. I'm Kathy Yang. The edge on hedge funds. It's time to get back in after a wave of redemptions. Our guest today managed to post consistent positive returns year to date. So much for the global financial crisis and Bernie Madoff. How exactly did he do it? But if you don't have enough to invest in hedge funds, what about the Asian equity markets? The MSCI Asia Pacific Index has rallied over 48% since March 9th. We'll check back with a skeptic who told us 2 months ago this rally's not going to stick. And keep those emails coming in. Our address is asiaedge@bloomberg.net. Keep your email short and clear. You can put our questions to our guest or any investment opportunity on your mind. We'll consult the experts for you. Let's head off to our guest here in Hong Kong. This RAB-Pi Asia Fund has been a consistent performer, posting positive returns year to date. That covers 1 year, 3 years, and 5 years, a rarity among the long-short equity funds in the Asian region. Its 7.6% gain over the past 5 years has beaten 90% of the biggest hedge funds in the Asia-Pacific region. The senior manager of that fund joins us now, Alain Barbezat of RAB Capital Asia, hedge fund manager best known for the natural resource investments. It's good to have you with us, Alain.
Thank you for having me.
So how have you managed to keep those positive returns? We've gone through a lot. I mean, think about the Asian financial crisis. The global financial crisis has started 8 months ago, and then you got the Bernie Madoff scare. Everybody was redeeming what they had in hedge funds.
Well, the key is to be a real hedge fund. What I mean by this is having a constantly long and short book in place, not just playing the upside. And at the same time as well, putting together bottom-up stock picking approach with a top-down overview. For example, last year, what really took the hand over markets was the deleveraging. Anyone who missed that suffered quite a bit. This year, it's quite the opposite, whereby the markets are reacting to a tidal wave of liquidity injection. And if you miss that and you look only at the fundamentals of the companies, again, you would suffer being too short in the market.
How did you keep the drawdowns from happening? Because a lot of the hedge funds were either closing up shop or a lot of the investors were just pulling out their money and wanting to hold cash.
Well, that happened to us, needless to say, even though we were positive last year. That's the deleveraging we were talking about. So it's also recognizing this potential risk and having the right book in place in terms of your liquidity profile.
And speaking of that liquidity profile, I know that the fund's aim is to have a low degree of correlation to the Asian markets. But now that the regional index has rallied 48% since March 9th, how is that changing your strategy for the fund?
It doesn't. I think the key is not to be brought back into markets in which you don't believe and over-leverage yourself again. It's keeping your strategy consistent.
And that strategy includes stock picking, both on the long and the short.
That's correct.
So you could get the alpha there. I mean, how does that work, the long book and the short book?
Well, the short book, obviously, in a bull market, most of the time plays against you. It's very difficult to extract alpha from the short book. But that being said, when you have problems in the market, it's there to protect yourself. I think the key of our performance has been our ability to avoid those big drawdowns. We've only caught 5% of all the drawdowns in the markets.
Yeah, and your short book is made up of the companies in negative growth areas where the quality of the management is under question.
That's correct.
So pretty much you're sticking with this kind of a strategy when it comes to the short book.
Yeah.
But what about for the long book? Because I know that you employ some kind of a top-down approach to that.
Well, the top-down approach applies both to the long and the short book as well. But on the long side, we look for quite the opposite from the short side. It's rather simple strategy.
Is it really simple? I mean, isn't it difficult to find good companies with that top-line growth in a market like this, coming all the way from the global financial crisis?
Well, that's, again, when you balance your book accordingly, where you put a little bit more emphasis on the short side rather than on the long side. And if you are with the right management, the right companies, then these stocks should theoretically come down less.
So there's the long and the short and that technical overlay.
That's correct.
You got to put that for the optimum price points.
Exactly.
How exactly do you decide to do that?
Well, we have 3 partners in the firm, 2 stock pickers and 1 person which is key in doing the technical overlay. So he'll be the one pointing out when markets are oversold, i.e. dangerous for the shorts or overbought, and reacting accordingly and balancing our balance sheet.
But basically, the bulk of your positions in the fund are structural positions. Is that correct? I mean, why the structural positions?
Well, you have to take views. Again, you have to try to step away from the market noise and the day-to-day move and have strong views. That's the structural.
Okay, what about the pursuing these opportunistic trading strategies? Do you ever employ that at some point so you can make money on the short term?
From time to time, we do, but it's never more than 10–15% of the book.
Not even in a market like this when the market is moving up, because you don't really follow the markets there. But what does it benefit an investor if they go for the opportunistic trading-oriented kind of a fund?
Well, it's a different strategy. We see it as more risky in a way. For us, we try to add a little bit alpha when we see opportunities from mostly a technical perspective.
Do you think investors have gotten back that appetite for the risky investments? Or
well,
are they still?
It looks like at this point. Yeah.
When did it start?
It's starting now, really. I think people are, it's the pain trade where everybody, as you mentioned yourself, was skeptical about the markets even a month ago, and now are starting to hurt too much and are capitulating and coming back into the market.
And where exactly is that optimism going into? I could think of China as a market. Is that a market that you could probably go long on? And if so, what are you shorting on in order to go long on the Chinese market?
Well, the trades for us this year has been long Hong Kong and China, mostly because of the huge liquidity injections from the Central Bank of China, and short Japan and Singapore, where we see structural problems there.
What sort of structural problems?
Well,
I can understand Japan, but why Singapore? And
well,
how are they similar or different?
Singapore is extremely sensitive to exports. Exports are 150% of their economy, first of all, and secondly, it has enjoyed a boom in real estate and property, and there's a lot of oversupply in that market, and that's going to come back and haunt these property companies in said the next 3 to 5 years.
Same thing for Japan?
Japan is more across the board. It's a real structural problem for them.
Okay, but what about valuations? When you come to think of it, the Chinese stock market is already approaching a 50% gain, and a lot of people are saying that this might be a pricey market to come into now. That's correct. It is. Valuations to core earnings across the region have moved between 11 to about 15 times. We're now 14.5 times, so we're very close to the top of that range. The markets are not, they're not cheap anymore. They were 3 months ago, they're not anymore. It's a slightly more dangerous game. You have markets that have become much more sensitive to any disappointment. So that's when we start to adopt, a little bit contrary to the market, a little bit more conservative approach and reduce our exposures both on the net and the gross. And you say the same thing for the Hong Kong market, the Hang Seng Index. What sort of valuations when you compare that with the mainland Chinese market? Well, the problem we have in these markets is, as I said, it's a liquidity-driven market, and you never know when it stops. It can continue like this. If China continues to inject liquidity, potentially we can have another bull market in China, and the market could double from here. Who knows? But if the Bank of China becomes serious and start to pump liquidity out, then the party is over, and valuations will probably come back down a little bit. Okay, just hang in there, because we're going to be talking about your long and short positions. I know that you got a long on Xinyi and Huadian, and a short positions in Komatsu and Makita, the power tools maker. That's correct. Thank you so much. And we'll have more with Alain Barbezat after the break. We'll hear why JP Morgan is expecting Asian stocks ex-Japan to go higher. Keep sending those emails. We'll be back in 2 minutes.